The market sell-off has continued as the Dow Jones just posted a loss for 6 weeks in a row. And now we also have an additional tariff added to the mix.
As Matt just mentioned, the Dow Jones was down for the 6th straight week and was down last week almost 3%. And the S&P 500 is also down for the 4th straight week last week, as it was down over 2.5%. Now the Nasdaq and the Russell were also down last week, about 2.4%. And now the S&P 500 is up over 10% for the year, as the Dow Jones is only up over 7%. The foreign markets were down almost 2% last week, but in a surprise move, the emerging markets were positive, up 1.2%, and that was mainly because of a nice bounce out of China. And now emerging markets up just over 4% for the year, while foreign markets are up about 8%. Today we want to look at a chart of gold. We want to look at gold today because there's been a lot of volatility in the markets over the past few weeks. And investors usually look at gold as a safer asset, especially in these times of extreme volatility. The chart pattern that we're looking at is known as a cup and handle, and this chart pattern is looked at as being a bullish signal. Now if you go back to June of last year, you see that gold put in a big U-shaped move until February of this year, where gold ultimately broke out and ran up to about $13.50. At this point, we saw gold make a back test back down to that February level where gold broke out of the U portion of this chart. And then last week, we ultimately saw another breakout out of the handle portion of this chart, which is the top blue line to the right. Now, we're looking at a potential move in gold up to a long-term resistance level at $13.50, which has been put in place for about 7 years now. So if we see a breakout above this $13.50 level in gold, that could be very bullish for the gold sector, especially with all the volatility that's been in the markets over the past few weeks.
Last week, President Trump surprised the markets by adding a 5% tariff on all imports from Mexico. And starting June 10th, that 5% tariff will start to increase monthly by 5%, capping out at 25%. And that monthly increase is tied to how Mexico and the United States will start to work together to figure out the immigration problem at the border. Now, the U.S. imports approximately $350 billion worth of goods from Mexico, mostly televisions, computers, and automobiles. So it's safe to assume that by the end of the year, we could see a rise in the price of those type of goods. The next big story from last week is that the yield curve between the 3-month T-bill and the 10-year Treasury is starting to widen, as the 10-year Treasury is sitting right around 2.13%, which is the lowest that we've seen on the 10-year in almost 2 years. The 3-month T-note is sitting right around 2.3%. Again, this has been one of the most reliable recession indicators, so it's something that we're going to have to continue to monitor. Also last week, Morgan Stanley released their U.S. Cycle Indicator Index. This index tries to predict how the U.S. economy is going to do in the future. And this index is predicting that the economy is going to start to see a downturn. This is the first time that this index has flashed this signal since 2006. Also, they noted that they're expecting a notable slowdown from the U.S. service sector, citing the economy around the world continues to struggle. This week, the Federal Reserve meets, and the markets are going to be watching closely to see what the Federal Reserve has planned if we continue to see increased volatility.
And also, as we're shooting this video on Monday morning, the Nasdaq is seeing a lot of weakness, especially out of 2 of its top components. So for the remainder of the week, we'll be watching the Nasdaq and the technology sector closely.
Thanks for watching, and if you're on Facebook, please like and share our video. If you're watching on YouTube, please like and subscribe to our channel.